Welcome, everyone, to the Australian Bitcoin podcast. In this episode, you're listening to myself, Justin, and Jeremy from HardBlock. Today, we'll be discussing dollar cost averaging and UTXO management. But before we start, a quick word from our sponsor. The Australian Bitcoin podcast is brought to you by hardblock.com.au, Australia's first and oldest Bitcoin-only exchange. HardBlock aims to help their users save in hard money and to become self-sovereign Bitcoiners. HardBlock has no added fees on deposit, buy, or sell transactions, so the prices are what you see or what you get. Sign up to HardBlock today using the discount link in the description below to receive free AutoSend batched Bitcoin withdrawals for 6 months. All right, Jeremy, how's it going?
Yeah, pretty good, Justin. How are you?
Can't complain. Good to be talking about a bit of Bitcoin again.
Definitely. It's something I want to kind of get my head around just for my own personal needs as well.
Definitely. So yeah, today we're talking about dollar cost averaging and UTXO management. So it's probably good to define those two terms. Dollar cost averaging, which people sometimes would probably hear as DCA'ing, is essentially like saving in Bitcoin.
Mm-hmm.
It's putting aside, depending on how you do it, but generally like a set amount perhaps of your, say if you're on a salaried employment, you might put aside 1% or 5% or 10% or something like that every pay, and you just put that into Bitcoin. I guess the important part of dollar cost averaging is it's a regular thing that you do, and it's not reliant on the price, as in you dollar cost average on a day when the price is high or the price is low. So it's very different to like trading, trying to get like the best price, high or low, to sell or buy at, and similar to being different to investing, where you're buying perhaps with like a lump sum amount.
Yeah, I mean, the concept of dollar cost averaging isn't specific to Bitcoin, and a lot of people are doing it without realizing it in their super. So when they put money in their super every month, every quarter, the super fund is buying money or buying shares or something for them on their behalf. And effectively, that is dollar cost averaging without them realizing it. I think we should maybe take a step back and think about, what we're trying to do is save. So we're trying to save we do some work, we earn some money, in inverted commas, a fiat, for that work. And then we want to save that to buy something in the future. Now, it might be you want to retire and you don't want to work and you want to, 40 years and you want to be able to buy food. Could be that you want to help your kids get ahead when they're a bit older and help them buy a house or go to uni, or maybe it's you personally want to buy a house. So the higher purpose is saving. And I think that's very important, because with savings, you don't want to take risk. You want to put away that money and know that it's going to be there for that important purpose like retirement. And to me, investing is a very, very different thing. And it's kind of become, I think, separated from what it really is. Investing should be, someone has a business idea and they're like, I've got this great idea. I want to do this business in whatever new industry. But I need some money, I need some capital to invest in the business and create the thing that, buy the factory equipment or whatever it is, build the brand before I can turn this into a business that makes money. There's risk because someone else could come into that industry and that business might fail. So that's a very different proposition of, I'm going to take some risk when I invest in this business, and I might make a lot of money or I might lose a lot or some of my money. And then you need to, research that industry and that business. So it's quite a different thing compared to savings. But I think because it is so hard to save these days, everyone is investing. When we were younger, you could just actually get a real interest rate and you could get a term deposit and you could just save. So at a high level, what we're trying to recreate is that ability to save again. Absolutely. And I think it's really good that you explain that. And it's indicative of the situation that we're in, where we need to describe what savings is. Yes.
Because it's become so detached from what it used to be, where now people will think of saving their money as, putting it in their superannuation, which is actually investing their money in potentially risky businesses, or asset classes, no matter what they were. And saving, on the other hand, is, just putting your money, keeping your money in money, basically, and knowing that it'll accrue in value over time. Of course, we don't have that anymore. So it's a bit of a strange thing to get your head around, I guess, as Bitcoin as savings rather than as an investment. But good explanation.
Yeah. And even the term saving your money, like you have to define two terms, saving and money.
Yes.
Because in my opinion, the Australian dollar is not money anymore. So you have to find a way to make it money, like hard money, and then you can save it. And by saving, I think, what I mean is, if I put aside some money now that could have bought me, say, a dinner or a litre of petrol, in 20 or 30 years, I can take that same money and buy that same thing again. That's, it's preserving your purchasing power. And so that you can buy, a house deposit or whatever it is. It's not that the money is diminishing in value. You're able to preserve your purchasing power of the work you did today. So, even those three words, there's a lot of meaning packed in there.
And because, again, that's why I try to reiterate that it's a consistent thing you do regardless of the price? Because I do hear sometimes people use the term dollar cost averaging or DCA'ing kind of incorrectly, where they say, I'm waiting for the price to be low, then I'll start DCA'ing. It's like, well, you're kind of just trading, or you're waiting to time the market correctly. And even though you might do it with a DCA type strategy at that point, the fact that you're not DCA'ing right now and waiting for the price to come down means you're not really DCA'ing. You're using like some sort of technical analysis to try to predict the market, or using emotions, depending on when it feels like a good price to you. So it's just good to come back to that point of it's a consistent thing, kind of like it used to be with an old savings account, if you remember those days.
Yeah. And I guess there's a third kind of category outside of saving and investing, which is, you could call it trading or speculating, where you're just trying to make profit off the price movements, which is essentially what you're doing. If you're trying to buy the dip, you're trying to get more Bitcoin, I suppose, through your skill of timing. I've spent, I know you have as well, a lot of time trying to learn how to chart, read books on it. And I feel like I understand as much as I'm probably going to. And what I've learned is that in the short term, I have no idea what's going on. I have no idea if this is the bottom. It looks like the bottom. When we're recording this, the price is pretty low. It's touching on the 30,000 US support line. But I thought it was the bottom a few times ago. I've been wrong many times. So, if I try and bought the bottom a few times ago, I would have missed this opportunity to keep buying. So I think those people who are decent at speculating, don't forget they've put a lot of time and probably lost a lot of money to get to that position, and they're still taking risk. And that's not what saving is about. So, look, it might be possible if you dedicate a lot of time to becoming a better speculator, but that's not. We haven't optimized for that. We've optimized for savers.
That's it. And you hear the stat bandied around, and I don't have a reference for it, so I do hate to repeat it, but I'm pretty confident it'll be accurate, where something like less than 5% of traders are actually profitable.
Yes.
And to a large extent, that still relies on what the market's doing, because you can have an amazing trader, but if the market goes against them, then all of a sudden they're not an amazing trader anymore.
No. Yeah. I mean, you can't predict external events like the COVID pandemic crash. It's got nothing to do with what's in the chart. That's in the future, and the chart's not going to tell you that. So nobody can predict those short-term future events. But what you can predict is that the fundamentals are going to drive things. So if you've done the research and you understand Bitcoin and you understand money, you can see that the long-term fundamentals are very strong. And that's what we're focused on here. Because predicting the long-term, I think, is a lot easier than the very short-term.
Yeah, very true. And it's probably a good point to stay on just a little bit, is that this is why we do dollar cost averaging, and especially why we do Bitcoin only. We believe it's the best savings vehicle that we have, given its scarcity, its decentralization, as well as a lot of the other properties that I think you can look at past podcasts to get a bit of an overview of what Bitcoin is. But we do often get a question from new customers when they join the site to say, like, how do I set like a limit order, or how do I buy the dip, or something along those lines? And some even want things like leveraging, like the usual order book trading that they might find at other exchanges. And so it's a bit of a, what's the word? Like a bit of a cultural difference, I guess, in terms of what we're trying to do, which is just to allow people to save in the easiest way possible in Bitcoin, rather than promoting or encouraging behavior that is going to more likely be leading to risk-taking or emotional investing, or again, trying to time the market rather than just spending time in the market.
Yeah. So let's separate those two. So you've got the buy the dip limit order type thing, and then the leverage, which is a slightly different thing. If you do try and buy the dip, as I said, I don't think anyone can really predict the short term, and so you're basically gambling, really, if you're trying to buy the dip, because you're trying to predict something that I think is unpredictable. So look, it might work some of the time, and other times the market may take off, and then you go and chase it and you pay too much. And I don't think you'll get a better outcome. If you do, it would be through luck. But you're spending a lot more time and a lot more emotional energy doing it. And we're going to talk about how we've sort of solved this problem with it at HardBlock. But you essentially don't need to do anything once you set it up. Like, no time required, no emotional energy required. You just set and forget. So, like, if you think you can eke out another few percent by spending the time doing it, that's all well and good. But, we've had to, when you design something, you make trade-offs. And we've designed our service to be focused on savers to make it easy for saving. So we haven't put in a limit order, even though people have asked us for it, for the reason that we think most people will probably not be better off by using it. With the leverage thing, if you think about what we're trying to offer here, if you think about like an old-fashioned gold deal, like you go and take in some cash and you just come out with some gold, we're trying to offer that here. So you come into us with some AUD, some Australian dollars, you can take some Bitcoin from us and you can withdraw it to your own wallet, self-custody it. It's kind of like if you go to a gold deal, you give them the money, you take the gold with you. Now, if you want to leverage that gold, you can't take it with you. It's in your account. So you're still essentially taking a loan from us, saying, yeah, you have this much Bitcoin, but we're going to give you a 10x like leverage. That's all in your account. That's not Bitcoin. We're here to help people save in a self-sovereign way. So when you take it out, you're just on the Bitcoin network. Nobody can leverage that. That's just, it's your savings that no one can ever touch. So that's our focus. There are other places, if that's what you want to do, there are places we'll offer it, but we're not going to do that. It's not aligned to our focus on savings.
Absolutely. And I would say it's not with people that are trading or using leverage, etc. That's not aligned probably to the overall values of Bitcoin.
Not at all.
Bitcoiners talk a lot about first principles, like going back to first principles. And if it doesn't make sense at that basis, then it'll never make sense the further you extrapolate out. And so Bitcoin is money. It's better money. But money has always been just a way to save the energy that we've expended or converted from something that's unusable to usable. It's not something that you would speculate on. It's not something that you would buy and sell unless you thought there was a better money available. But the point is, if Bitcoin is the best money, which it is, you would not then be trying to like trade it or invest it and sell it later on. You'd be saving in it. It would be the thing that you hold. So I guess at a very first principles basis, money is meant to be saved. So Bitcoin is meant to be saved.
Yeah, and I think when you look around, there are different agendas out there. So as an exchange, like every exchange, we make money when people buy or sell. So one exchange might decide, well, if we can get people to buy and sell more, we can make more money. And we haven't gone down that path because it's not aligned with the Bitcoin values. It means we're going to grow more slowly than other exchanges who are encouraging the trading. But most of those techniques are offering people this kind of potential short-term riches right with no effort. Meanwhile, they make all the spreads every time someone buys and sells. So you're not getting impartial advice a lot of the time if you're thinking that an exchange is helping you when you're offering leverage and trading and all that sort of stuff.
Yeah, it's very true. It's probably good to talk a bit more specifically about how do we set it up? Like how does HardBlock set it up to make it convenient and make it easy just to dollar cost average in that way?
Yeah, for sure. So the vision for what we're offering here is just the old-fashioned savings account. It's a set up, set and forget. So you decide to put a certain amount a month or a week into a savings account. In the old days, that would give you interest. We want to recreate that basically. So it's the set and forget aspect, and the interest rate has been replaced by Bitcoin, which can't be printed. And we have the wonderful opportunity that this is like new money that's being created that's going to be adopted. And if you get in early enough, then you'll get that boost as well. But the general concept is it's a savings account. So how have we done that? The first way is you've got to bring money into your HardBlock account, obviously. So you can set up a recurring deposit from your bank account. So you can control everything in your bank account. We have a feature called auto buy. So if you deposit with EFT or PayID, it'll automatically buy Bitcoin when the money arrives in your account at whatever price that is at that time. So if you just want to buy Bitcoin and you're not taking it out today, you can leave auto buy on, and just every time you send money in either by EFT or PayID, it'll just become Bitcoin. So again, saving, like, I did it this week. The price was pretty low. I just put a bit extra money in. I knew it would become Bitcoin, and I got an email back saying, this is how much I got. This is the price I paid. The second feature is called AutoSend, and that allows you to do an automatic Bitcoin withdrawal, so to the blockchain, on-chain transaction, to wherever you want to take it. It's designed for people who want to take it to a hardware wallet, but if you've got some other solution, that's fine. So essentially, with that feature, you put in a threshold. So once your balance gets to over X, it will schedule a transaction for you. You tell it an address, and I think we'll come to some of that details around that, the addresses, a bit later. And then you just switch it on. Now, how it works at our end is we do a once-a-week batch transaction, and we give it a low priority fee. So that keeps the fee as low as we can possibly get it. By combining many users into one transaction, to one batch, we can split the cost of that transaction across everyone, and it allows us to keep the fees incredibly low. So if you sign up to that transaction, the fee is 99 sats, which today is 4 Australian cents, which is essentially nothing. And that's something that we're committed to. So it's not going to change in the future. And ideally, we'd like to bring it down. But currently, we're saying it's 99 sats. And as you mentioned, if you get to sign up with the referral code, you can have that for free for 6 months.
Absolutely. And so we're saying it's depending on how you look at these steps, it's like a 4 to 6 step process. Sign up and verify your account.
Yep.
Set up auto buy, or more so turn on auto buy, because you don't really need to do much to set it up. set up AutoSend, which means you put in what address you want it to be sent out to, what your threshold is, and then go into your bank account and set up a recurring payment.
That's right.
There might be an optional step in there if people don't want to reuse addresses, which maybe we'll talk about in just a little bit, where perhaps after they receive one of those automatic withdrawals, they go back into their HardBlock account and they then put a new receiving address in there for next time. But again, that's not a requirement. It's more so of a personal preference if they do that. So that's a relatively straightforward process. I do know a query that we've had so far has been when people go to set up their recurring payments in their bank account, that some banks will let them do that for PayID, but some will only let them do it for EFT deposits. Some banks will let you put in daily recurring payments, but some banks will only let you put in, say, like weekly recurring payments. So generally my advice is, well, if they don't let you do PayID recurring payments, you're kind of stuck with doing EFT. That's more of a bank thing than anything else. However, for the time or the frequency part of things, there is kind of a workaround. So say if you wanted to do daily DCA'ing, you could technically set up 7 different weekly recurring payments, just starting on a different day. But if that seems a bit too cumbersome, what I'd suggest is normally maybe set up like 3. Just do like a Monday, Wednesday, Friday or something along those lines. And so you're setting up 3 different weekly payments. So 3 of them will trigger each week, which means you're basically dollar cost averaging every second day or so. And that's a nice way to work around some of the bank limitations.
Yeah, I mean, we're sort of getting to the frequency question here, but I guess just a comment that we didn't build the recurring aspect of this within HardBlock because it's already built into the bank accounts. And just as a kind of high-level summary, with that process in place, so you've got your recurring bank account transfers, your auto buy, auto send, sending to your hardware wallet. You actually don't have to log into your HardBlock account. So the Bitcoin is flowing basically from your bank account to your hardware wallet without even logging into your HardBlock account. So that's the simplicity that we were focused on. I guess in terms of what you're saying about banks won't let you do daily recurring payments, I don't know whether it needs to go down to that level. Like, do you need it every day? I'm not sure. I mean, most people are probably taking that money from their future pay. And so if you're getting paid weekly or fortnightly, I feel you could just set it up for the day after you get paid or something. If you're getting paid monthly, maybe you would do it twice a month or every week. Every week seems reasonable to me.
Yeah.
I'm not convinced of the argument of why you'd have to do it every day.
I think some people just like the feeling of it going in there every day.
Yeah.
Because I agree with you where I think I wouldn't want to set up 7 weekly transactions to keep recurring. I would probably set up 2 or 3 if I wanted that kind of daily DCA feeling. But technically how I actually do it is more like every week or 2. Just because, I don't know, that just makes the most sense to me because that's generally when the pay frequency is. That helps me kind of budget better with other expenditure. And it ends up being slightly more of a significant amount, which might be then ready to withdraw rather than really small frequent payments. But look, whatever people are comfortable and what their personal preference is, I think there's ways around it. I guess that's the point.
Yeah, I mean, I think monthly is not frequent enough because you probably miss the big dips down.
True.
Whereas weekly, I think you capture them. I guess a comment, the batch transaction does go Saturday night. So if you were doing it once a week, we'd recommend Thursday or Friday is probably the best day to do it so that you're minimizing the time that your money is sitting in your HardBlock account.
True. I just had a thought there. So one of the benefits of DCA'ing, and perhaps one of the reasons people like to do daily DCA, or at least would say like more frequent DCA than say monthly, is if people are spending their Bitcoin, which I always encourage them to do so to kind of bootstrap this circular economy, there is capital gains tax implications if you're selling your Bitcoin, which is essentially what you're doing when you're spending it. It becomes like a potentially capital gains tax event. If when you're spending it, it's significantly different from when you bought it, either whether the price is up or down, that's something that needs to be reported. So if you're dollar cost averaging, you actually have a larger pool of Bitcoin with various, timeframes from when you bought it. Some of them are going to be very close to when you're now spending it. And of course, you'll have a very large range of different prices that you've bought it at. And because you can choose which Bitcoin you're spending, so it's not like a first in, first out or first in, last out type of system. You get to choose which one you employ. It gives you more opportunity to just have a personal expenditure rather than a capital gains tax event. So something to consider, not tax advice. I think always talk to your accountant if you're looking at regularly spending Bitcoin. But I guess that's something that I have heard back from people that do it, is it makes it easier to justify when it's personal use, because rather than buying Bitcoin at the high and at the low, they bought Bitcoin all throughout the entire range, which lets them then spend the Bitcoin that they want or the kind of price that they want to spend it at, if that makes sense.
I guess the flip side of that is you also have a lot of transactions, both in your bank and in your HardBlock account. And if you've got the emails turned up, on, you get a lot of emails as well.
It's
so
true.
it depends. It's all that balance, isn't it? Depending on what your priorities are.
Exactly. I think that's probably going to be a theme in this session, is just that it's not really any perfect solution. It really depends on personal circumstances, your preferences. And normally there's like a bit of a trade-off with things like convenience or risk, or convenience and privacy, or that kind of thing.
Yep.
So I wanted to just maybe talk a bit about the non-batched sends or withdrawals that we have, because there's just been a recent upgrade to allow a bit more customizability to that fee when users just withdraw. So if they're, say, still using HardBlock, but not using it with the auto send feature, they can still withdraw quite normally. And our fees are, I would say, probably the lowest in Australia, if not among the lowest in Australia. At the moment, I think it's something like 200 sats or 204 sats, just based on the mempool fees. But yeah, there's a bit of difference to that now, isn't there? So there's like a standard fee and a fast fee. Do you want to talk just briefly
sure.
about that?
So I mean, basically with the entire account, you can still do everything manually. So if you just leave all the settings off, you can buy manually, you can deposit, and so on, and you can withdraw manually. So what we've done recently is we've given the users the opportunity to choose which fee they want. We get our fees from mempool.space, which I think is the best blockchain visualizer and the best fee estimator. And a lot of people are using it now. Like the Moon Wallet, I think, uses that for their fee estimation. I think it's a lot better than Bitcoin Core. And
could you maybe even explain a bit of the difference? Because I found that really interesting.
Okay, sure.
Coming into it, and other users might not be aware of like Bitcoin Core and mempool space, the way that they do calculate the potential fees.
Yeah, sure. I mean, I did a lot of research into this when we were like designing this these features. So Bitcoin Core basically looks backwards and uses exponential moving averages on the most recent, on the blocks, but I can't remember how long it goes back, but it's very slow moving, because it's looking back, okay, the last block got this fee, and it's going back, say 100 blocks or something, and saying based on this, and it uses an exponential moving average, it'll put in maybe a slightly higher fee. It's very slow to react to changes in the market. Whereas mempool.space, they create what they think the mempool looks like, and therefore the next blocks based on the fee priority. So they build the entire mempool, which, if you don't know, is like the pending transaction. So if you send a transaction and it says pending, it's sitting in the mempool waiting to be mined into a block. So that website takes the mempool and says, okay, based on all these transactions, the next block will probably look like this, and therefore the fee to get above the transactions in that block is this other fee. And so they give you 3 fees on their website. They tell you the fee to get into the next block, to get into 3 blocks away and 6 blocks away. Now, a block is meant to take 10 minutes, every 10 minutes, but it's not always that way. But in theory, that's like saying, well, the fee to get your transaction confirmed in 10 minutes is the high priority fee, and then half an hour is the medium priority fee, and 1 hour is the low priority fee. So we offer users the choice between the high priority fee and the low priority fee. And so we just pull it from, that's the fee rate. We pull it straight from mempool.space on an API. And you have to also multiply the fee rate by the amount of bytes of the transaction. They're called virtual bytes. That part is quite complicated. But essentially, the scarce asset in Bitcoin is the data in the block. So there's a fixed amount of data that can fit into a block, and everyone's paying to get that data recorded, because that data is recorded on, 50,000 plus nodes, right? So that's the scarce asset. We multiply our transactions by about 200 virtual bytes, which covers us, because there's a lot of different scenarios that it's not always easy to predict how big a transaction will be. But the short of that is you can choose a fast transaction, which should be done next block most times, or a medium transaction, which should take about half an hour. The mempool space major advantage is when all of a sudden a whole lot of transactions hit the mempool but haven't been confirmed. Bitcoin Core can't see that because it's looking backwards, whereas mempool space is looking forwards and going, and this happened last week, right? I think it was Binance dumped a lot of transactions at quite a high fee rate. All of a sudden the mempool completely changed. And if you weren't using a mempool-based estimator, you would have taken a long time to realize what was happening. But if you are watching on your patient, and we also changed our site, at the top of the site, you can see the fee. So it says send at the top of the site. That's the standard fee. When I looked just before we started recording, it was 9 cents for a standard fee. And most of the time that should be processed in half an hour. So yeah, if you do want to, I use it sometimes to pay for services. If you just want to use your wallet like that and just do a transaction today, because it's not convenient to wait till Saturday night all the time.
True.
You can just use the manual transactions and then just use this little slider there if you want to go medium or fast priority.
That's it. I think that's a really good explanation as well. And it shows that using something like mempool space versus Bitcoin Core to calculate that fee means you're normally getting a faster transaction at the cheapest price possible, but also not sending the cheapest price possible and getting a very, very slow transaction accidentally because someone's just dumped a bunch of new transactions in the mempool. Or the mempool gets cleared up because we have a lot of blocks get cleared relatively quickly, but then you're still overpaying for your transaction because it's looking at all the past transactions rather than what's actually in the mempool. So yeah, good explanation. And also the reason that HardBlock has made that decision is to try to keep it, firstly, best for the customer in terms of convenience and fees, but also it's not on a profit basis. It's just cost recovery.
That's right. We just don't want to lose money on these fees because we have to pay, like it's our wallet that is paying the fee to the miner. So we're just trying to recover that fee, but we have to do it on an average way because not every transaction is the same, depending on number of imports or what type of address it is. They actually have different amounts of virtual bytes that are required. So it's a surprisingly complex area trying to forecast Bitcoin fees.
Definitely. Just to clarify something for users as well, if you have AutoSend turned on, you can still do the manual sends as well. It's not like a one or the other. Like you did mention that people can still do it manually, absolutely right. But it's not like if they choose to do the AutoSend, they're not allowed to then do it manually as well. Like you can have an AutoSend set up, but if partway through the week you decide I need to send a transaction for a certain amount, or I need to send a small portion of this Bitcoin in my account, you can still do that in a manual fashion. And if you're still above your threshold by the end of the week, the AutoSend will also trigger as well.
That's right.
You can use both of these two things interchangeably at the same time, or if you want, one or the other.
Yeah, or you can turn it either auto buy or AutoSend off and on at any time.
That's it.
So you don't have to keep them on for, if you decide you don't like it, AutoSend, turn it off and switch back to manual. If you need to do something manually, you can also turn it off for a couple of days.
Exactly right. While we're talking about design choices, so one of the other queries that comes up sometimes, and given we're very privacy focused in terms of the advice we give to people and how we try to manage data here as well in our own operations, is the receiving address choice. So when doing something like an automatic withdrawal, there is a choice there in terms of, do we ask people for one address they wanted to go to? Do we ask people for their entire extended public key, which then lets us generate every address that could ever relate to that particular key? Or do we ask for like 10 addresses, something like that? It's hard to strike a balance. What sort of thought process went into that?
Yeah, so initially I did want to do that kind of multi-address focus and make it very convenient and users not having to reuse addresses. And essentially the best way I found to do that was to get the XPub, which A, is a bit complicated. Like not everyone's going to be able to know what that is and where to get it.
True. Yeah.
And B, we just don't want that privacy responsibility. Other exchanges do it that way and we chose not to do it because we don't, we just don't want to know that. So then the other option was we thought about users could put in 10 or 20 addresses and they get kind of randomly used and recycled, but not every wallet looks ahead in the same way. And we didn't want to have a solution that maybe someone withdrew some Bitcoin and their wallet just wasn't searching for that address in the blockchain. And then they might freak out that they've lost their Bitcoin. And so again, from a simplicity perspective and making sure that it was interoperable with every wallet, we felt on balance just offering one address was the best solution. So people who don't care about address reuse will just use that one address. Yeah. People who do can reorganize their wallet. I mean, maybe they're going to mix, but we just thought this is kind of a holding area where you can set this up and forget about it for 6 months. And then maybe after a while you think, oh, this is a bit messy. I'm going to go reorganize this when the fees are cheap. But I still think on balance, that's a better outcome because you're only having to do that once every so often. You're never having to log into your account. But yeah, the XPub would have been a very convenient solution. But as you know, privacy and convenience are often opposing forces. I
was going to say, I think this is a great spectrum to look at because, XPub would be most convenient for kind of everyone involved, but also the least private, 100% the least private way of doing it. Whereas having one receiving address is not the best privacy, but it is convenient enough for most people. Yep. And anyone who doesn't like that privacy trade-off can then, as soon as a threshold has been reached and the AutoSend's been triggered, they can go in there and change the address. Or they might have it received to the same address a few times and then mix those funds anyway, or do a coin swap. Like there's a lot of other things that can be done outside of the exchange from a user's own wallet to improve their privacy again after that point. And doing say like 10 or 20 addresses, that's really difficult, I think, for a lot of users because most wallets don't even present you with all of those addresses at once. No. They present you one at a time. So Can you imagine saying to a user, just go into your Blue wallet and just go to the generate address button and just do that 20 times and each time copy perfectly what the address is and then give us that very long list. And I think that's kind of too impractical for a lot of users at the moment. And not only that, but it gives a bit of a, what's the word? Not false sense of security, but it's easily to be forgotten, I believe. Whereas if they think, I got plenty of addresses, I don't need to worry about that. And then before you know it, they're now reusing addresses without realizing. Whereas if you know, I only have one address in there, once I receive to that one address, which I'll find out because I get an email about that, if I've set up email statements, hypothetically, I can then go in and change that. Whereas if you have 10 addresses, you kind of have to keep track of like, which address number is this? Do I need to go and change that? Or it just becomes very cumbersome.
Yeah, I think, philosophically, we want to have a service that works for beginners. And so beginners who, want to be self-sovereign. And so this does that. But we also want to offer something that the advanced users will benefit from. And from my perspective, the advanced users can benefit from like a low fee or market rate fee manual transaction if they really want to very private and not have to put the address in the threshold. Or they can still benefit from the ultra low fee on the AutoSend and then every so often just do a wallet reorganization. I think on balance, that's less effort than trying to plan the 20 addresses and keep track of, okay, some money is going to come in here eventually, but I don't know when. Because then you, like if you, for your own personal needs, you might need another address in the future. That might be address 21. Fairly sure the Ledger wallet only looks 20 addresses ahead. So it got very complicated very fast. And we just thought, let's keep it simple. Let's make it work for beginners. Advanced users know how to use it. And they'll figure out the best way that works for them.
That's right. Even in the way that wallets will, if you're trying to restore a wallet, it'll look at those addresses. If you've, say, jumped 20 or 30 addresses ahead, it might say, oh, this Bitcoin wallet has no Bitcoin in it. Of course, you can, most of the time with those wallets, say, no, I need to look at a custom range. I need to look at 100 addresses ahead or something along those lines. But it can be a cause for a heart attack, essentially, if you don't realize how they work, that they're not scanning all 2 billion potential addresses. They're just scanning the first 20. And if they find some, they might scan the next 20 and so forth.
What is the maximum number of addresses? Is it infinite?
So, it's around 4 billion. Generally speaking. However, we use something called hardened derivation paths and hardened like parent keys. So by doing that, it actually removes about half of those potential addresses. So practically speaking, a normal Bitcoin wallet that uses that pretty standard way of using hardened like parent and child derivation paths will have about 2 billion receiving addresses that it can generate.
Yeah, which is why it can't possibly scan every address ever.
No, exactly right. Yeah, and you wouldn't want to have the 2 billionth one being the address that you've chosen somehow, because you'll be waiting for a while for wallet software to even be able to look that far ahead.
Yeah, exactly right.
So I think that's probably a good explanation of why DCA'ing is the better option to deal with Bitcoin. Why we've made that our focus at HardBlock. Why the design choices that we've made in terms of like receiving addresses, in terms of the fee calculations have been done for like the auto buy, auto send, and even just like the manual processes that people can undertake on HardBlock. So I'm curious now to talk a bit about like UTXO management, which is like, all right, well, if I'm going to withdraw either manually or by auto send, how much should I withdraw? What should that threshold be? And look, to answer it briefly to begin with, and then we'll go into more detail, how long's a piece of string? Because there's a lot of predictive elements to the answer to that question. So firstly, just to define a quick term, UTXO means Unspent Transaction Output. That is essentially Bitcoin that's sitting in your wallet. It's not always the receiving address, because you can have multiple UTXOs in one receiving address. And so if you do reuse receiving addresses, you might actually have multiple UTXOs. But essentially all it means is unspent transaction output, which is generally if you're going to spend Bitcoin, you need to have a UTXO there to spend, which is something that you probably either got in your HardBlock account that you were then withdrawing out to spend it, or you've already withdrawn it out into your wallet and now you're about to spend it. So UTXO management is a pretty big topic. And I guess I've got some questions that I just like to pose back in terms of things to consider. So I guess if you're going to want to manage your UTXOs, you need to figure out, are you saving or are you spending? And if you're going to be doing both, which is probably the case, it's like, what proportion are you saving versus what are you spending? Because normally I would suggest larger UTXOs for saving seems reasonable. Smaller UTXOs for spending is probably the best in regards to privacy. I could make a very general statement and say smaller UTXOs is just best overall for privacy, and larger UTXOs are probably best for convenience and also fees. Because if you have multiple small UTXOs that you need to combine to form a transaction, that is actually when fees start to increase, because usually fees are more heavily influenced by the input side, as in that the UTXOs that you're combining, for example, or not combining if it's just one to make the transaction. Whereas spending to a lot of different addresses isn't that much more costly. So when I mention things like convenience, what I'm thinking here is like, if you're going to get a loan against your Bitcoin in future, you probably don't want to have to put together like 100 UTXOs that are each worth $100. You're probably better off having one UTXO that's worth $1,000 or $10,000 or $50,000, depending on what you've got. The other thing is things like self-managed superannuation funds. Is if someone says, say you're not taking a loan against your Bitcoin, but they say, we need you to prove that you own that Bitcoin and that you still have custody of it. Do you then go and sign 100 UTXOs with your private keys to prove that you own it? Or do you just sign maybe like 1 or 2 or 3 UTXOs to prove that you own it? So yeah, there's a spectrum there where convenience with big UTXOs and also cheaper fees with big UTXOs, but there's much better privacy with small UTXOs. But ultimately it comes down to like, what are your spending versus saving habits?
I think an analogy might be useful here. So, because UTXOs are a bit hard to get your head around, but I like to think about them like notes in your wallet. So let's say I go to the bank, I can choose to get out, if I go into the bank, I get like a $100 note, $50 note, $20 note, $5 note. But let's say I want to spend $1.73. I don't have a $1.73 note. I have to break a $5 note. But if I only had $100 notes, I'd have to give someone $100 and they'd give me the change. But then you're saying, oh, this big spender with $100 notes in his wallet. So it's important to understand that the wallet doesn't have this kind of big pool of Bitcoin. It's got these UTXOs, which are like notes. And so by choosing your threshold, you're effectively choosing the amount of the value of the UTXO or the size of your notes in your wallet. So when I go to the bank, not that I do it very often, I'm thinking about like when I choose the notes that I'm getting out, I'm like, what do I need this for? Do I need 20s or 50s? The other factor is, even though we generally recommend taking your Bitcoin off the exchange, if you are doing the DCA solution, your Bitcoin will spend a little bit of time on the exchange, like a few weeks, maybe a month or 2. So if it is a larger amount, maybe you want to kind of get that off every week. But if, sort of thing, I think a lot of people are doing like $10 a week. So I think an example might be useful. So if you put $10 a week in right now, the current price, you're buying about 23,000 sats. So if you think, okay, well, maybe I want to set my threshold at 100,000 sats and have UTXOs at about 100,000 sats, they're probably going every 4 or 5 weeks. You could just take it out every week because the fee is only at the moment, it's 99 sats, which is about 4 cents at the moment. So like from a fee perspective, it's probably not a big deal if you do it every week or every month. But then do you want a 23,000 sat UTXO 20 years from now? I don't know. Because the thing that goes around in my head is, what is a fee going to be 20 years from now?
Yeah. And I don't think anyone can predict that 100%, but you can kind of do a bit of like back of the napkin maths where you say, all right, at the moment, most blocks are being mined and the reward for miners is about 6.4 Bitcoin. So 6.25 of that is actually the new Bitcoin being issued, and the remaining is just the fees that people are paying at the moment. So if you look at it that way, right now, the issuance of new Bitcoin is accounting for about 97 to 98% of the miners' fees. Now, every 4 years, that amount halves. So in about 2 years' time, it'll be 3.125, whatever the mass is on that, Bitcoin each block. And then, of course, in the 4 years after that, it reduces again by half. So over the course of time, in about, let's just say 40 years' time, 10 halvings away, you would need to have like a complete reversal of that to some degree, where if the issuance of new Bitcoin is only accounting for, say, like 2%, 5%, 10%, then the actual miner fees themselves, the amount that users will be paying each time they send a transaction, are going to need to account for the remainder of that. Now, it's really difficult to predict like what a miner's cost is going to be, because there is a supply and demand element here. If they're spending more on things like electricity, if they're spending more on the actual hardware itself, there might be miners that actually would kind of demand more, or not turn their miners on for anything less than a certain amount.
But then if the value of the Bitcoin rises relative to the cost of power, they wouldn't need to rise as much. Like it might be that in the future, 0.4 Bitcoin in a block and fees is a lot because the value of the Bitcoin has risen so much.
That's exactly right. Which is why I say it's very difficult to predict like what are fees going to be in 10 years, 40 years, 100 years, that kind of thing. What I could say is that I'm expecting there to be a pretty healthy fee market. So we can probably assume it's going to be like at least what it is now, if not more. But then, of course, the Bitcoin that you have is worth more as well.
Yeah.
Which means makes it very difficult to predict even in terms of your spending habits. Like 100,000 sats now might seem like a ludicrous amount to have in a spending wallet in, say, just 5 or 10 years' time.
Yeah.
Like as a practical example, I recently went through the process of setting up a Lightning wallet and opening a Lightning channel just for spending, which is the most private way to do it, is to have one node with one full UTXO that you've spent into it and one channel. Now, you don't have to do it that way. I just wanted to experiment doing it the most privacy conscious way. So I had 75,000 sats that I was doing that with, because that seemed like a relatively sort of, it's enough, but not too much. With if it goes wrong, I'm not going to be too concerned about that.
Yeah.
Now, most channels, or most nodes that I was trying to set up a channel with wanted at least 100,000 sats.
Yeah.
And some wanted more like 250,000 sats, 500,000 sats. So it took me quite a while to end up finding a node that had a good connectivity with other nodes that I could route payments through that would let me open up a channel for about 75,000 sats. So I would say people are spending at the moment and have the intention to open up Lightning channels with their UTXOs. You'd probably want them to be at least 100,000 sats, or maybe even ideally like 250,000 sats. But if you were doing that in 10 years' time, that might seem ludicrous of an amount to open. You might actually only need to have like 10,000 sats or something.
Yep.
So it's very, very hard to say. What I would like, the general advice would be have an assortment of UTXOs and look at your habits and say, well, how much of this stuff am I going to spend versus how much am I going to save? And if it's something like I'm going to save 70% of it, I would say like you want most of your Bitcoin to be in just a few UTXOs, because then you can take loans out against it and it's easier. You can verify ownership of it to the bank or to a self-managed super fund auditor much easier. And you're not really degrading your privacy that much because you're not moving that Bitcoin around. You're not going and spending like half a Bitcoin UTXO for a coffee at the coffee shop.
Yep.
And then the coffee shop owner says like, oh, wow, this guy's got like a lot of Bitcoin. You have it sitting there in cold storage, essentially. Whereas, say, in this hypothetical example, 30% of it is you do want to spend, it wouldn't be outrageous to think you might actually have between like 20 to 40 UTXOs to make up that 30%. But again, depends on your spending habits. That might end up being something like $100 or $200 a UTXO. But if you're like, oh, I buy antiques and they're each $1,000 each, or I buy car parts with mine and they're like a couple of grand each, where you'd say, well, you want your UTXOs to be somewhat close to that. You can always combine them. You just don't want to be combining like 5, 10 UTXOs at a time. You just want to combine a couple, or maybe have one that you spend.
Yeah, if you're thinking long-term savings, there's a couple of things we know that are true. One is, and you touched on it, the cost of the transaction is largely dictated by how many inputs there are. So each input is a UTXO. So if you have to combine 10 UTXOs, that becomes quite an expensive transaction. The other thing we know is that the transaction fees are going to be paid in Bitcoin when sats. So it might be that you have to pay, today you're paying about 200 sats for a cheap transaction. Maybe in the future, maybe it still is 200 because Bitcoin is worth more. Maybe it's 2,000. But let's say you're in this situation, maybe you're giving your child some Bitcoin when they start uni or something. If you give them 1 million sats and they have to pay 2,000 sats, which is still a large amount of money for a transaction fee, but they've got 1 million sats, they're probably pretty happy.
Yeah.
And it's a once-off fee, after 20 years. So that's probably okay. So I think listening to what you're saying and thinking it through, seems like smaller UTXOs are probably better when you're planning further ahead, because you can still split them up into lots of outputs later. But if you've got a lot of inputs, you're going to have to pay potentially quite a high fee.
Yeah.
Then on the flip side, if you're going for larger UTXOs, your Bitcoin is going to sit longer in your HardBlock account. So maybe there is a process where you do have to do a bit of reorganization every couple of years just to combine those small ones into a bigger one when the price of a transaction is low. Just so you don't have that problem later on where fees are really expensive and you've got 100 UTXOs to combine.
Exactly. And I would say it's always a trade-off. So smaller UTXOs isn't better infinitely. It's like to a certain point.
Yeah.
Like I would, not just because of as you combine UTXOs, you pay higher in fees, but there could come a point where you can't pay the fee with the UTXO that you have.
Yes.
So like opening up a Lightning channel might cost you like 5,000 sats, and you've got like a 7,500 sat UTXO. You're probably not going to find a channel which has a 2,500 sat requirement, and then you can actually pay the fee with it. So to some degree, it's like you want Yeah, many UTXOs is better for spending, less UTXOs is better for saving, but that comes with some privacy risks. But at the same time, if you're not really spending it that much, the privacy risks aren't as big of an issue. And you can also separate that up in time if you want. Same as if you have smaller UTXOs, but not too many of them, you can always combine them at some point if you want, or spend them individually. What I will say on this point as well, because if people are wondering, like, I don't get why is like having a big UTXO a privacy issue, probably the best example is just that coffee shop example, where if you go and spend that UTXO anywhere, someone can see that's where that money came from. But the thing is, privacy options when you've withdrawn to your own wallet are now becoming so much further developed than what they were just a year ago, or especially like 5 years ago. So if you have a very big UTXO that you've been saving, and then you think, okay, now I want to start spending this UTXO, you don't have to keep it in a really big UTXO. You can say, well, now I'm going to put it through a bunch of coin join mixes and break it up into 50 smaller parts or 10 smaller parts, depending on what I think I'm going to spend it on now. There's things like coin swaps, which work in a similar way, but have less of a footprint than a coin join. You can open up lightning channels with it and break it up into smaller parts that way. That's actually not that great for privacy, but at the same time, it's much harder for someone to then trace that back to the on-chain. So I guess my point here is that if you end up with a bigger UTXO, I feel like you probably have more options to then break that up into smaller part in a privacy-preserving way. Whereas if you have lots of small UTXOs, you eventually have to merge them to then make a bigger one to then spend, and that's really bad for privacy, also bad for fees, also kind of bad for convenience, because you have to sometimes, if you're really keen to do this, track like, where did this UTXO come from? What have I spent it on so far? Like, who knows this belongs to me? So if you have to track 100 of those, that becomes really difficult. If you have to track like 5 of them, that's really easy.
Yeah, the way I kind of visualize the future, and it's quite a lot influenced by Safedean's books, is that the Bitcoin base chain in 20 years, it'll be kind of like you might use it to buy a house. So it'll be really expensive. Like it might be in today's equivalent, like $500 in transaction fees.
Yeah.
But you wouldn't do it very often, like once in a decade. And you would use Lightning to just pay for groceries and coffee and so on. So if you're kind of thinking, okay, in the future, Bitcoin will be this really expensive thing, you want to minimize your touch points on chain. And that like naturally leads to minimizing inputs and minimizing UTXOs. So you might, 20 years from now, you've got all your retirement savings and now you've retired. So you might have this one-off transaction to set yourself up where you take your couple of UTXOs and then turn them into, I don't know what, Lightning channels or whatever solutions are available at the time. But if you've, like you said, if you've got lots of little ones and each one gets in by the fees, you might not have much Bitcoin left.
Yeah, I think at the moment a dust transaction is considered to be anything less than about 800 sats.
Yep.
Because what a dust transaction is sometimes people will spray a bunch of very, very small transactions out to a bunch of different wallets that they're trying to monitor, or a bunch of different receiving addresses that they're trying to monitor. And naturally, people often will merge that small dust transaction with another UTXO that they own.
Yep.
And of course, the person that sent that now knows that's also your wallet, and they can kind of track it a little bit better. So like, that's where the term dust comes from. It's like a dusting attack. But anyway, at the moment, it's about 800 sats or less. Wallets that have a dusting attack, like alarm on it, will say, this looks like it could be a dust attack because it's less than 800 sats. In future, that could be 8,000 sats or 80,000 sats. Like, we don't know how expensive it's going to get.
Yeah.
And again, look, you could still merge those things. There can be batched inputs, which I know are coming. But it's additional fees. It's additional, inconvenience that you have to put up with. So I guess kind of what I'm saying is, like, I would err on the side of larger UTXOs than smaller UTXOs if you plan to have them for a decently long time, as in you're not going to spend them in the next 6 to 12 months. If you're going to spend them in the next 6 to 12 months, you probably have a pretty good idea of what size they need to be to spend that. In which case you can break it up into whatever amount you want. But if you don't know if you're going to spend them, or if you are, how much, I would say you just want a few relatively big UTXOs. Sorry.
Yeah, and the other thing was when you are putting your receiving address into to the AutoSend feature, or anytime you're withdrawing into a UTXO, the different address types make a big difference to the amount of fees you pay on the transaction. So if you've got the old address types, which starts with a 1 or a 3, correct me if I'm wrong.
Yeah, no, you're correct.
Those are going to add a lot more bytes to the transaction, and therefore you're paying for the bytes. Whereas the newer ones that start with like BC are much more efficient. So if you do try to set it up, try and use the transaction receiving address starting with BC, and you'll be much better off in the future.
And on top of that, we've got the BC one Oh, no, I've started saying it and then I can't remember. Is it BC1P?
I think it's
BC1P
P.
is taproot.
Yep.
So in future, there'll be taproot addresses. I mean, we already have them now, but most wallets haven't implemented them yet. And you'll be able to save additionally on fees. So any transaction that might seem out of reach at the moment, if you forecast forward in terms of fees or merging UTXOs or even doing things like multi-sig contracts, which are quite data intensive, that'll be quite different once Taproot has a much better adoption in terms of usage. And that won't be the last upgrade that Bitcoin has. I'm sure if it becomes untenable to ever use UTXOs of a certain size, rather than those just being then discarded entirely, I'm pretty confident that there'd be some developers looking at ways to say, how can we still use those UTXOs for something? How can we like use them for fees, or how can we like merge them in some way using a different address type that we haven't even considered yet at the moment?
Yeah. So I think, and you would expect that in the future there'll be even newer address types that use lower fees, but you're stuck with the address type that you've withdrawn your Bitcoin onto when you did it. So yeah, if you can use the most up-to-date wallet version you've got.
Yeah, absolutely. It still freaks me out when I see people using the ones and the threes, like the legacy addresses or the nested SegWit rather than native. It just there's not much benefit to doing that.
Yeah, I think they just don't understand and they haven't gone around to upgrading. And
that's it. Look, that's most of the stuff that I figured that we'd covered in today's session. Again, some of those responses are sort of how long's a piece of string.
Yep.
But I guess the point that we kind of settled on there is that larger UTXOs might be better if you're not sure what you're going to do with it, or you don't really plan to spend anytime soon. And once you get to the point of needing to spend, you can break that up into smaller parts in privacy-preserving ways, probably much easier and with less fees than having to combine a bunch of smaller UTXOs that you had sitting there.
And then I'll take the flip side again. If you are doing larger amounts, like maybe it's your super, I'd probably minimize the time on the exchange. So maybe you send it in on a Friday, and you take it straight out on the Saturday, and you reorganize it once a year or something. But if you are doing smaller amounts and you're comfortable keeping those amounts on the exchange for a few weeks or a couple of months, definitely use a strong password with a password manager and two-factor authentication, which will secure your account much more than if you don't have those things on. Absolutely.
That's a good point. Again, knowing that everything is a trade-off, if you decide to have it sitting on an exchange for longer, you want to make sure that you're secure with that. Same as if you want to have larger UTXOs outside, you want to deal with that properly privacy when it comes to spending it, or if you've got lots of smaller ones, you want to deal with that in terms of good privacy as well. So there's always trade-offs, and just be aware of what the trade-offs are when you make the decision. And if you're ever keen to talk about this stuff, you can always send us a message with your either hypothetical or personal circumstances, and we might be able to brainstorm a bit about what things you might want to consider.
For sure.
No worries. Well, thanks for your time, Jeremy.
No worries.
Thanks everyone for listening. If you have any comments or feedback, you can reach out to us on HardBlock BTC on Twitter. Otherwise, thanks for listening, and until next time.